Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. The bond markets took the limelight yesterday. The Silicon Valley Bank's parent company, SB Financial, announced it would be raising funds via equity after it realized a loss of almost 1.8 billion following the sale of a portfolio worth 21 billion. This particularly led to a sell-off in banking stocks in US as investors worry about the risks lurking in bond portfolios of other US banks. The US two-year yields have fallen sharply. The cycle high was 5.08%. Now it's trading at 4.79%, which is lower than the pre-Powell testimony day. On the domestic front, RBI announced a repo action of 1 lakh crore to manage advanced tax-related outflows and to manage the spike in short-term yields. So a lot of actions happening in fixed income markets. JK, what are your thoughts?
Good morning. Yes, I think they are estimating around 2.5 to 3 lakh crores of outflows towards advanced tax as well as GST in the next fortnight. That's the reason why RBI has actually gone for a much higher repo auction, just ahead of these outflows, and that is not surprising as well. But as we start the day, we also have had a BOJ policy meeting decision where broadly they maintained everything in status quo, and there is no change in the yield curve limits as well. And dollar yen has not reacted much because market this time was almost prepared for such a decision, and therefore we've seen dollar yen hovering in the same range. Of course, we will wait for the Kuroda's press conference at 12 p.m. IST, which will be his last press conference as BOJ governor. Even staying on the rupee, of course, it's really again a duel between the inflows and the central bank. A large fall in USD-INR from 80 to 30 that was seen on Tuesday, rather Wednesday, was followed by a large selling from foreign banks, which have been seeing good outflows. But in yesterday's action, when it tried to break 80 to 70, once again, RBI was back. And obviously, they're trying to rebuild their reserves, which they have spent at higher levels to arrest the fall of the rupee. So good thing is RBI rupee is not reacting so much to the global events. It's more going by the domestic flows and the RBI actions. The rupee will also take its cues more from the inflation number on Monday and the trade numbers on Tuesday. The trade deficit is expected at 20 billion, which is higher than what was seen last month at 17.75 billion, but definitely well below the average of the last 6 months. So rupee should be held in a range between 81.70 and 82.30 for couple of weeks at least as we are into the financial year. But as you said, there was a risk-off sentiment in the New York session, with banking sector leading sizable losses of 1.66% in Dow, 1.85% in S&P, and 2% in Nasdaq, with the global composite index falling nearly 2% as well. The troubles in Silicon Valley-based SVB Financial Group facing liquidity issues, and its share fell as much as 62%. The crucial lender for startup businesses is the banking partner for nearly half of US venture-backed technology and healthcare companies that are listed in the stock markets in 2022. Obviously, they even triggered a negative sentiment about the health of the financial sector as a whole, with KBW banking index in the US down 7.7%, the biggest drop in one day since 2020. This may be the beginning of stress in the financial sector, as we are in the still in the heightened state of rate hikes by the Fed, and this could not have come at a worse time, even as the crypto exchange Silvergate has decided to shut, and that decision was taken a day ago. Technically, the stock indices in US do not look good, with the widely watched S&P 500 closing below the 100 and 200-day moving averages. Immediate focus is on the monthly jobs report today. Market nervously looks at last month's blockbuster number, although consensus is still for a rise of only 2 lakhs versus 5,17,000 in January, and unemployment rate pegged at 3.4%. Wage increases at 4.7% year-on-year versus 4.4% last. And the last of the Fed speak before customary blackout period from Mary Daly was non-committal on the quantum of March rate hike, wanting to see additional information on the economy before making any decision. And I'm sure tonight's job number will be one of the things they will be watching closely. But we do see some stress signs emerging in the job market, as we could see in the higher level of job cuts in the last 2 months, as depicted in the Challenger report. US employers are slashing jobs this year at the fastest pace since 2009, with companies having announced plans to cut 180,713 jobs so far this year in 2023, which is up a staggering 427% from 2022. The report said while initial job cuts were seen in the tech sector, it's now across all 30 sectors. So it's just possibly the beginning of the stress that the employment sector is seeing. In fact, the other indicator was a big jump in the weekly jobless claims to 211,000 from 195,000 expected by the market, and the previous number was 190,000. So even if the NFP comes higher than 200,000, signs that the job sector is cooling is evident, and it's likely to get intensified as Fed hike rates towards 5.5% or beyond. The weak numbers and risk-off sentiment helped a modest rally in bonds, with yields correcting across the curve 2-year by nearly 20 bps from the highs, 5-year by 17, and 10-year by 11 bps. Even as the market expectations show that 61% still favor a 0.5% increase in policy rate by the end of this month. Currencies enjoyed a reprieve after the jobless claims data, finding a reason to correct the sharp fall seen after Powell's testimony. We cannot see dollar falling too far without more concrete evidence of the economy cooling off, even as some market participants are actually calling for a policy rate to move up to 6%. But it's really completely data dependent. And if we do see a stream of weak data for the month of February, which will be published this month, I think there can be some, solace for the market players, particularly in the stocks and the bonds. Thank you.
Thank you, JK. And lot of developments which are happening on the domestic front. We are seeing some repo actions from RBI for the advanced tax-related outflows. While rupee, we have got the trade deficit numbers which will be coming up, and it is expected at 20 billion. And the view on rupee remains that it should be in a broad range. While the BOJ meeting, they maintained status quo, and the US banking sector took all the limelight with sizable losses in the US session because of the troubles with the SVB financial group. It's also important to remember it's the banking partner of a lot of fintech companies. So how all of this plays out, we need to see. On the data front, we had the monthly jobs report. We have the monthly jobs report today. 2 lakh is roughly expected, and the jobs market seems to be under a lot of stress, as we have seen this year a lot of jobs being cut. So let's see how all of this upcoming stream of data is digested, and probably we'll see how that is reflected in the Fed funds expectations. That's it for today. Volatility is making its way back. It's important to manage this risk and have a solid risk management policy. Do connect with us if you require some professional help. Thank you so much for listening.